great to be here. Thanks a lot for including the paper and the program. So I have been working in household finance, mostly related to consumer credit and mortgage. So this is the first paper that I worked with annuities. So very fitting topic for the conference. So I'm looking forward to comments. This is a very early paper, very early project. So I'm not bluffing when I said that I'm very much looking forward to kind of ways to improve it. So it's co-authored with Borja Larraín from Católica University in Chile and Alessandro Creditero from Indiana. I don't have to say why you want to study annuities to this crowd, but I want to kind of spell out why do we want to, what do we think is the big kind of motivation to set up our paper. So the notion here is that there's a worldwide trend away from defined benefit programs to defined contribution plans, and that you can roughly separate the process into two. The accumulation phase, in which investors face autonomy and enrollment, contribution rates, portfolio choice, and there has been a vast literature showing that nudges such as auto-enrollment, auto-escalation, default asset allocation have improved kind of the way that houses are accumulating those assets. In the accumulation phase, though, so retirements also face a lot of autonomy. So, to some degree, when to retire, what are the withdrawal rate, what is the asset allocation that you choose when you're doing that, and to some extent, there's very little guidance and very kind of underdeveloped markets in that dimensions. And why is that relevant? Because retirees face this longevity risk or the risk of outliving their retirement nest. So here's where annuities kick in. Basically, annuities are going to be this vehicle through which individuals hedge their longevity. What are we going to do in this paper? In this paper, we're basically going to ask the following question. Is there a treatment effect of annuities? Okay? So besides the important selection of effects of choosing an annuity, is it possible to conceive that annuities directly affect longevity of individuals? All right? So what we're going to do is we're going to use a sample of 65,000 retirees from Chile, and we're going to investigate this relationship between the choice of an annuity and how long people live. What are we going to find, or what I'm going to be showing you today? We're going to use recent fund market returns at your retirement age as an instrument for the decision to get the annuity. And we're going to document that after high fund market returns, retirees are less likely to choose an annuity, and choosing that annuity is going to increase longevity by somewhere between 2 and 5 years, depending on the specification that we need. All right? So these are not a trivial amount, and we're going to try to decompose that effect by the end of this presentation. We also have another piece of evidence that suggests that people that choose the annuity because they they face lower returns just before retirement are less prone to disabilities much later in life. So that's going to be evidence that these annuities are affecting longevity and also affecting the health status of individuals. Okay, so that's the motivation, the broad overview of this. I'm going to talk to you about the data, the setup, talk to you about the empirical strategy, and then show you the results. So what is the data? And we're using, as I said before, we're using data from Chile. So why Chile? Chile was one of the first countries that privatized defined contribution systems in the 1980s. We're basically the guinea pigs of the world in terms of defined contribution, right? In the 2010, around 10 million participants were in the system. For a country like the US, 10 million is nothing. For Chile, that's basically at that point, 60, 70% of the population. On average, 85% of individuals between 20 and 65 contribute to the pension system. And in the accumulation phase, and this is relevant for the setup that we're going to look into, you basically have workers contributing 10% of their taxable income to these funds. These funds are privately managed. There are different companies that manage it, but the choice of fund is restricted. So you have only 5 funds that you can invest on. They are called Fund A, B, C, D, and E. So not a very original name, but they're basically ranked based on the risk profile that they have. So think about like Fund A as like being mostly kind of like stocks, and Fund D basically being fixed rate, and like basically anything in between is going to be a mix of the two.
Just to clarify, when you say risk profile, this is an atemporal risk profile or an intertemporal risk profile? Because those are distinct things.
Yeah, so it's like basically, it's in the cross section. Think about that. So you're basically like Fund A is going to have 80% of like stock market allocations, and like if Fund E is going to have basically 80% fixed rate. Now, that is not age dependent. If that's like
No. So it's the variability at a point in time, episodic variability versus variability over time. Those are completely different things in terms of people's risk preferences, and that's what I'm asking. So it sounds like it's atemporal because they haven't thought about it.
Yeah. So I mean, it's just it's basically the first one. It's not like over time. It's basically like a risk profile, like a difference in risk at a given point in time.
But of course, just to finish the logic, we're talking about pensions, which are streams over time, so there's a mismatch there. But I'll leave that. But what?
Yeah, I mean, so I think that I get where you're going for. So again, it's not the purpose of this paper, but like the time series they mentioned is left to the individuals because they can switch across funds.
Yes, but with one final thing, and when you start claiming certain things, like you said earlier in the accumulation phase, nudges were successful, by what metric? If you aren't reflecting the correct risk preferences, but let's keep going.
So I think that I understand what you're saying. Like there's been like kind of like revisitation of these findings and trying to understand the actual final effect of like these nudges and like the accumulation. Again, like we're just trying to put this paper in the context of that, not making a claim to what extent those nudges can be like welfare improving and so on and so forth. Okay, so it's just to give you an overview of. But I think that you will have to agree with me that there's a lot of focus on the accumulation phase and choosing individuals. I mean, like helping individuals choose, not so much on the deaccumulation phase. That's kind of like the motivation that we were after. So in the deaccumulation phase, what happens in Chile, and this is like very unique though, to the extent of my knowledge, you guys may disagree based on your knowledge. The legal age of retirement is 65 for men, 60 for women. That's not the unique part, by the way. Retirees can choose between what we're going to call a program withdrawal and an annuity, or a mix of those. Okay, so you basically accumulated your wealth over time, retirement's hit, and now you basically have a choice. You either enroll in, you basically take an annuity, or you can get this program withdrawal. Okay, now how does this happen? You basically submit your information, or basically your fund firm, actually, so the fund managers submit this information to this like platform that is like managed by the regulators, and that platform serves as an intermediary to get bids from insurance companies. Okay, so you submit this quote with your information, and you get back a report that will basically have information with respect to the quotes of different type of annuities, and I'm going to tell you in a second where they are, and kind of like a simulation of what you will get if you face a program withdrawal. Okay? The payment under the program withdrawal is also regulated, so it's not that you can basically get a lump sum. Okay, so here we're not comparing an annuity against a lump sum. We're basically comparing an annuity with kind of like this option of getting a stream of income to live for a year, and then keep the rest of your balance invested into one of those funds. Now, the choice of funds there is restricted to kind of like fund C or lower risk, okay? So, but the notion here is that if you choose the program withdrawal, hereditary risks are going to be exposed to a kind of market risk fluctuations, okay?
Are there minimum withdrawal rates?
Yeah. So there's not a minimum. There's like a given withdrawal rate. So basically, like I'm gonna show you in a second, okay? But when you get the annuity offer, you get the offer of like the menu of like different type of annuities, a cross section of companies that are bidding to provide that annuity, and then the amount that you can withdraw if you want to choose the program withdrawal. And that amount is given by a formula that it considers kind of actuary tables and some mix of the annuity yield return and like past market return.
What if you want to retain a lump sum for contingency?
You can't.
You can't.
Yeah, you cannot do it. So that there is an option of like a postponed annuity where you can get a lump sum that is also restricted how much, and then you can start the annuity in the next year. But again, it's like limited to some extent. It's not that you can get the whole lump sum out.
So
right?
no Chileans leave bequests to their kids? I like it.
Yeah.
Well, how do they do that if they can't do a lump sum?
So like the annuities have, I'm gonna give you
Okay.
like the summary in a second, but the annuities actually have a bequest, you can have a bequest guarantee
Okay.
attached to it, basically.
Okay, and you can mix the annuity with the PW, as you say, yeah.
Yeah, but the mix is intertemporal. Basically, you say, I could take the program withdrawal now, and then in the next period, I could choose an annuity
Oh,
for
okay.
the rest of it. Okay, so another very important thing that is useful for our setup, like these annuities are inflation indexed. So in Chile, for the banking crisis of 1980, there was basically an introduction of an inflation indexed currency that banks used to like basically lend to the real estate, kind of like very expensive, like high schools actually charged in this currency, and it was set to incentivize lending from like a bank perspective, and that kind of sticks over time. So basically these payments are made on that kind of currency, so they're inflation indexed, and those type of annuities have a guarantee period, and basically when you choose an annuity, you are not facing this like longevity investment or longevity risk, okay? So the system is called SCUMP, and was introduced in 2004, and therefore we're going to study the period between 2004 and 2022. So this is so in the first page of the kind of like the report that you will get like the quotes of each of the annuities, and this is what you will get in the part of like the program withdrawal. So you will have an indication of what is your first payment, so the payment that you're going to receive monthly for the first year, and then you're going to have a simulation of how much the money that you have is going to last based on like some smooth function of like previous returns, okay? So this is the information that individuals are facing. Now, how do the choice look like? So within the sample of people that have basically submitted and accepted one of like these offerings, we have around 7,000 individuals, okay? And here's like the different type of annuities. So you could have an immediate annuity where like basically the annuity started this year. You can have something that's called a deferred annuity, where you basically defer the annuity for certain months and then the annuity starts. And then you have the program withdrawal that I told you before. Now, just to be clear, here it says guarantee annuities, so you see that kind of like annuities could be guaranteed. This is a guarantee period for bequest motives. So like basically, on average, individuals would get, like if they choose to guarantee, they will guarantee about like 12 years of their kind of post-retirement age for the kids to receive kind of like the annuity as a bequest model, okay? So in terms of like amounts, so just to give you an idea, here the amounts are in like this inflation indexed currency, but like roughly the amount that is accumulated on average is around $120,000, $130,000. So that's like the balance that people like on average get at the end. And as you can see there, the initial monthly payment that you receive is somewhere between 50 and 70% of your last income. Okay. So that's like kind of if you want to think about the replacement rate, how much money are they receiving? And here you can see one of like the motivations for people to get the program withdrawal. Basically, this is like comparing the first year of payments, okay? So we only have the information for the first year of payment for program withdrawal. You get kind of like a 20% higher kind of like monthly payment when you choose the withdrawal. So if you like basically were to look at here, kind of like the annuity will be a line going somewhere between 50 and 60 flat across all years, extending beyond 87 basically. And kind of like the withdrawal is something that starts high and then kind of like an expectation fades over time. Questions?
So, forgive me for being stupid, but if I'm going to do like, I want to keep the principal throughout my entire life because that's my rule of thumb and I just want the income off the top, the system's going to punish me a little bit, is what you're saying. It's going to incentivize me to go down the withdrawal route rather than just...
So let me rephrase the question to see if I understand that. You're saying if you want to receive that extra 15 or 20% of income the first year, you're basically going to have to go with the withdrawal and that's going to generate, I mean, that's how it works.
Okay, I see. Thank you.
Now the withdrawal, remember, is basically like relying on your outstanding balance and that's going to fluctuate over time. So like what they show you is a projection, doesn't mean that that's going to be the realized cash flow that you're going to get. So how are we going to estimate the causal effect of annuities? We're basically going to look for an instrument that affects the choice of annuity, but without affecting longevity through other like kind of channels. And what we're going to rely on is like basically some previous literature in the annuity market that has shown that kind of individuals are more likely to choose annuities during poor market returns. And here basically Chalmers and Reuter that use pension plans in Oregon and Previtero that use like basically pension plans in the US shows that basically people react to like previous stock market returns when you're thinking about annuities. So we basically can replicate those facts within our data. So here what I'm showing you is the annuity take-up within our sample period, and the red line is basically the previous 6 months returns on like the fund C, so the intermediate return fund. And as you can see, basically, the pointer doesn't really work here, but as you can see, kind of like when the past 6 month returns go up, the annuitization take rate kind of goes down. When it goes down, it goes up. So that's basically, if you like were to run the pure correlation here, there's like a negative correlation of like close to 0.5, okay? And that's gonna be kind of our source of exogeneity here, so nothing fancy. We're gonna run conditional, and here we're gonna focus on the individuals that die. So we're gonna basically look at conditional and you retiring, and we observing you to die. Kind of, we're gonna run this like very simple IV strategy where we basically instrument the choice of annuity with past returns.
Are you going to check that a change in the state of the economy has no effect on longevity?
Yeah,
so assume it?
Yeah, I'm gonna have something to say about that. So we're gonna be controlling for a lot of things. So we're gonna be controlling for gender, like the last study that you have, balance, kind of like cohort fixed effects. So we're gonna basically control for like birth cohort and the acceptance kind of time cohort that we are looking at.
So you're not going to check the validity of the IV? That's what I'm asking. Because the question is, there's a lot of relationship between health generally, including mortality, also morbidity, and the state of the economy.
Yeah. So I'm gonna have to jump a little bit ahead, but like
in a
nutshell, I think that what you're saying. So I am in the spirit of discipline, kind of like the exercise. I'm basically first gonna try to say to what extent this actually seems exogenous with respect to like the population that we're looking at. But then, of course, and I think this is where you're rightly going for, kind of like at the end of the day, even if you believe that the instrument is exogenous, this is like basically a time series variation. So like cohort effects that affect like things, omitted variables that will affect different cohorts at different point in times as business cycles is something that could potentially violate the exclusion restriction. I'm going to have something to say about that in a second. But it's going to be kind of outside of the paper itself, but if you have any ideas of what we can implement with the data, I will be more than happy to discuss it after.
But
Okay?
there's a huge literature on this link between mortality.
Yeah, so like,
Published on this.
yeah, exactly. So okay, so like, let me jump ahead, I guess. Like, so like basically like, and this, correct me if I'm wrong, there's like a big literature that says that basically like depression like increases longevity, and this is like the Rome 2000 paper that kind of says like if you look at like mortality after recessions, it seems to reduce overall mortality. So this will be kind of like something that could potentially explain our results. So the way that we kind of like push back a little bit on that is that there's a new paper, and I have it here, I can't remember the authors at the moment, that basically argues that if you actually replicate that exercise, but look at cohort effects, okay, it turns out that people that are older and later in life, when they're facing a recession, they're actually more likely to die early. So that kind of like goes against our finding, because we're basically saying during low return periods, people are more likely to get an annuity and then they live longer. If you take that paper as face value, basically they say recessions hit, all people actually live shorter. So like it's going to be a bias against us finding a result.
If I may, you made a very important point there, because Chris Room did all that work when he was actually at Georgia State, and we kind of know that stuff well.
Perfect.
There's massive distributional effects. I
Right.
think that's going to be key to this story.
Precisely.
If you're looking at near retirees.
Yeah, exactly.
But you really need to talk about that, not as if I'm
No, yeah.
yes,
And I have it there, and if you have read the draft, I apologize because that's not something that we have in the draft at the moment, but that's precisely where like most of our focus is now, trying to basically rule out potential stories that go through like cohort effects, which is kind of, and this we think about as like one
I would want to hear that right now. When you
Okay.
say this is a good instrument, my head said no.
Okay, fair enough, that's good.
So an alternate way to talk about the first stage is that there are three groups here. There are always annuitizers, never annuitizers, and then those induced by the instrument, the returns to annuitize, the
Yeah.
switchers.
Yeah,
If you
The
thought the
compliant.
switchers were innately healthier,
uh,
then that gets you a bias because you have a correlation
Right, yeah,
between the
yeah,
returns
yeah,
and your second stage.
Yeah.
So I'm worried here that the heterogeneity in returns is gonna bias this, because what the instrument is doing is switching the healthiest people from being non-annuitizers to being annuitizers
Right.
without any causal effect.
Yeah. So like we have this conversation like yesterday over lunch. So that's something that I'm not gonna have much to say about now, but it's like something that with a little bit of structure we could basically look into and like think about like where like the different populations affected by the instrument. So I don't have much of it right now. I could take about like a characterization of compliance that I did last night, and I basically like it's gonna be consistent with the heterogeneous effect that I showed you at the end. But yeah, that's like basically definitely in our to-do list to understand kind of like what this is happening. Just to give you kind of like the idea of the kind of like the instrumental empirical strategy in a nutshell. You basically are facing retirement at time t. There you have a decision to annuitize or get the withdrawal. We're gonna look at within that year variation on the previous 6 month returns on the fund, and the exclusion restrictions that you guys like all are very much aware of it is that kind of like whatever happened to those prior returns are gonna affect longevity only through kind of like the annuity choice. And here's where like all these like cohort effects are going to be important to try to rule out.
So, clarification question. Does everyone make this decision at the same age, or is it an endogenous decision to choose when to retire?
Good. So we're gonna have two samples. So we're basically gonna call it like the first sample like all retirees. So this is like the distribution of age of all the two samples split by gender. So you see that there is a massive mass at 65 for men and at 60 for women. That's like the standard retirement. Early retirees here, like you shouldn't think about people that have a disability. These are basically people that accumulated enough kind of balance, and this is like again regulated. So if you have enough balance accumulated, and you basically like from this perspective of the government you made it, you actually can retire early. Okay, so those are like basically the individuals that are in like this part of the population. Okay. So we're keeping, there's like some potential endogeneity there. We're keeping it in like one of the specifications because we think that interesting. I'm gonna show you that when you look at the balances of those summaries, that they don't look as balanced as the standard retirement people. And basically the standard retirement people is gonna be kind of like the focal kind of like regression that I want you to look at. So here like the summary stat for the kind of sample of people that die. And so you can see that basically the retirement age is like lower than the standard retirement age, and like that when you look at like the covariance amount kind of like in a reduced form setup between low and high returns, kind of you see that there is some statistical differences across them. Now when you look at the standard retirement sample, that's kind of like all those differences in terms of like how much salary you had just before retirement, the balance that you accumulated, how many years you contributed to the system, they kind of like balance out. And this is going to be kind of like reassuring kind of like evidence that this is like basically mostly driven by people that kind of decide to retire. They had to retire at even age. Okay? So these are the results for the whole sample of retirees. So the OLS regression basically shows no effect on longevity. This is like a bit surprising for like if you put it in the context of the literature and this like notion of like the endogeneity of annuities. If you think about the setup within Chile and the high annuitization rates, kind of like this, I guess like less scope for selection there. And in column 3, you basically have the first stage, kind of that 0.052 coefficient implies that one standard deviation in returns, it leads to a 2.5 lower annuity take-up, and like basically we can detect a weak instrument. Now, column 4 on the AB basically says that if you were kind of like pushed to kind of get an annuity because of low market returns in the past, you are gonna differentially live 4 years longer. Okay? Now, when you look at the standard retirement, basically that effect goes up. It's something around 5.5. The results are robust to kind of including like, so these are specifications here are from like an older version of the paper, so I didn't want to confuse the audience. If you basically control for like these acceptance year cohorts, kind of the results are robust and the coefficients are slightly lower. Okay. So in terms of like placebo test, the things that we have done so far, we basically can look at like returns like that happens before the 6 months. So we look at the accumulated returns a year before, a year before, 6 months before, 3 months before, and then like a forward-looking regression. And like reassuringly, we see that most like the positive correlation between past returns and longevity is like there for past returns, not there for forward-looking returns. So there's like it doesn't seem to be kind of driven by that. And like here's basically like what I just said about cohort effect. This is like something that we need to we're working on, like basically making it a more focal part of the paper. The notion here is that I convince you about the exogeneity of the instrument. Kind of the remaining kind of like identification threshold is this notion that cohort effect could invalidate the exclusion restriction. And here, like the most salient ones is the one that we just discussed. Basically, there's like, I'm just like citing room, but there's like, as you guys mentioned, a vast set of like papers that shows that mortality rates fall when the economy deteriorates. This could potentially explain our results. Now, luckily for us, like there's like new papers that are coming and basically arguing precisely what was argued in the back, that there's like a distributional effect of that, and it seems that for like older people and people that are kind of like within our sample, basically lower returns actually tend to shorter life, which it will like go against our findings. So just to recap the results so far, I'm showing you that annuity increases longevity somewhere between 2 and 5 years. So here, like any kind of like benchmarking will be great to receive. The one that kind of like we find that is kind of like similar to what we looked at. There seems to be evidence in like the kind of like medical literature that argue that if you quit smoking at age 65 for men, you basically are like gaining 1.4 to 2 years of life. So like that's kind of like a benchmark in terms of like the magnitude that we have. So OLS versus IED, it seems that like OLS understate the effect of annuities on longevity, and we believe that this is like linked to like the institutional setup, and in a way kind of like if you think about the Chilean system, it kind of like it's like pushing people to annuitize, and in that sense like kind of like there is the annuitization rates are a lot higher than anybody else, any other place that I have seen. And we have a lot more to do with respect to like the compliance and the local average treatment effect. And kind of if you kind of like one piece of thing that I could say, basically Alessandro is like job market paper argue that kind of like this effect of like past returns is associated to extrapolative belief, and kind of like, and if you believe that this will be inconsistent with like a rational wealth effect affecting like the longevity. Now, in the last 7 minutes that I have, I want to show you another piece of evidence that we brought up to the table. This is like a different sample. We're going to use kind of like a survey of socioeconomic conditions that is run biannually in Chile as a representative sample of the of the Chilean, like my mind is crazy here, of the Chilean population in the 2000s. And it basically asks questions about pensions that started in 2011. So this is like a much kind of like newer sample. It's a survey, but the key thing there is that within that survey, they ask individuals if they have retired. So we have that kind of information, and also the type of retirement that they choose. So if they choose an annuity or a withdrawal. The issue here is that we don't know exactly when they retire, so we're going to replicate the same IV strategy, but we're going to assign the treatment, and so we're going to assign the previous stock market returns based on the kind of the standard retirement age. So it's like a simulated instrument, you know. And where the outcome variable is going to be here like 10 health questions that are asked to individuals to understand kind of like to what extent they can do daily activities. So like, for instance, they're going to ask, can you eat by yourself? Can you kind of get dressed by yourself? Go to the bathroom by yourself? So the scale is between 1 and 5, and we're basically going to either look at the maximum score or the mean score across all those 10 questions, okay? So we replicate the result. Like here we have like, I don't know, fewer controls. We're still gonna be controlled by income, gender, and age. I mean, we're gonna use age to kind of like control, assign you the treatment. And then what we're gonna look at is we're basically gonna replicate the same result. And here, what we find is that basically, if you annuitize, on average, you are less likely to declare after you retire that you have disability, okay? So like, and this is like basically in the scale to 0 or 5, it is like basically a 1-point reduction in disability. Now, this is not a panel, okay? This is a cross-sectional progression, but what we can do and what we're doing here is like basically we're gonna define for each observation that we looked at, how far are you from retirement, okay? So like, we're basically pushing a little bit the data here, but when we do that, I could show you like a plot that looks like this. So here's I basically mimicking the reduced form, okay? On the y-axis, we have the years since retirement for the individual that we observe in the survey. And then I'm just like plotting the means of the disability index for people that kind of like retire in our simulated instrument during low and high retirement environments. And what you can see here is that basically the two groups look very similar in their disability up to year 15. And then year 20, 25, and 30. I mean, like, I wouldn't put too much weight on the 30 because there are very few observations in there. But like in 20 and 25, it seems like basically, especially in 25, individuals that retired during high return, that they were less likely to take an annuity, are more likely to exhibit disabilities later in life. So this is consistent with them kind of like diverging in terms of like health status, not at the moment of retirement, but like 10 or 15 years later after retirement. Okay, again, consistent with this notion that there is a treatment effect. Now, I think that like, if you take so far the results at face value, this paper brings an opportunity to basically kind of like unite two literatures, okay? What is the reason of that? So like there's this notion that people that choose an annuity are people that have longer life expectancy, okay? And this is basically why kind of like people like that think about annuities and the adverse selection in it think that annuities are associated to longer longevity. Now, there's another set of literature that argues that basically people are very bad at predicting their life expectancy. So in a way, we see our results are like basically bringing a bridge between these two findings, that basically if you think that annuities have a treatment effect on longevity, then kind of like these two things are these two findings are no longer kind of contradicting.
It's also worth noting that actuaries have done a horrendous job, given the amount of longevity swaps, the trillions of dollars of longevity swaps in recent decades. So it's not just ordinary folk.
Okay, great. Perfect. So in terms of like the mechanism, I don't have that much to show you today. This is another argument that we're basically exploring. But we think, and here's like basically the takeaway that I want you to walk away from this talk, is that this treatment effect is a combination of like these three mechanisms. So basically the first mechanism is this notion that, as like you were pointing out before, kind of like the program window may give you like a higher amount at the beginning, but in expectation is gonna fade over time. So if like health expenses or things that would expand your longevity are backloaded, kind of like getting an annuity give you availability of cash going forward. Now, the fact that you don't have to think about your investment allocation may reduce your anxiety, and that also may kind of lead to like longer living. And then there's like this notion of like the pure incentive effect. If basically I'm gonna give you kind of like money as long as you live, you have the ultimate incentive to live as long as you can. In terms of like the moral hazard, like the piece of kind of quote-unquote suggestive evidence, and I shouldn't say quote-unquote, really suggestive evidence in here is basically if you were to look in the US, the Health Retirement Survey, kind of like, and you like separate people, this is like tabulations, okay, not like a causal argument here, which is also consistent with the adverse selection story, but like consistent with ours too, that basically people that have an annuity in that survey are less likely to smoke, more likely to do sports, they like have a slightly lower weight as well. So kind of like consistent with this notion that kind of like there's an active thing that individuals are doing. And again, very suggestive. Now with respect to like the heterogeneity, we have done a heterogeneity that suggests that kind of the results on longevity are larger for like high accumulated balances, so like richer people, and earlier cohorts. So basically like this effect is kicking in later in life, okay? Which is consistent with like this the mechanism of like availability of cash, okay? So that's all that I have for you today. So to conclude, we're basically using a sample of 65,000 retirees from Chile to investigate the link between annuities and longevity. Choosing an annuity increased longevity between 2 to 5 years. Annuitants have better health status much later in life. And like the key idea that we're gonna push from a policy point of view is that our results have like very strong implications for the design of retirement income solutions, from the defined contribution plans and the pricing of annuities and insurance companies. So thank you. I'm much looking forward to the discussion and the comment.
Okay, pleasure to discuss this paper. Very interesting to read. This question is important, of course, because research has shown that there is asymmetric information in annuity decisions. Those who buy live longer. Now it's a causality issue. Do we think it's adverse selection, or moral hazard, or both? If it's risk affecting coverage, it's selection. If it's coverage affecting risk, then it's moral hazard. The difficulty is separating the two, and in annuities it's a little bit more difficult than, say, in car insurance, because we don't get repeated occurrence of the risk, we only die once, and so that's kind of a little bit more difficult question to answer. A lot of studies, when you read various of the studies in the literature, the classicals that you start reading, they dismiss sort of very quickly moral hazard. They say, well, it's impossible, that people are kind of impacting their longevity after they get the annuity. And this study gets us to think about that. And here from a public health, if I take your results at face value, it's one of the biggest public health discovery ever. You can take retirees, give them annuities, and we're going to live longer. Of course, insurance companies are going to make a lot of losses, but that's a whole different thing. Okay, so that's interesting. The IV setup is fairly simple. So you have the second stage, the equation of interest, with Y as a function of whether you buy an annuity. Annuity as a function of that return on funds. The beta OLS is about 0, the beta IV about 4. And if you look at the first stage, it's about minus 0.5. And if you do the reduced form of the outcome on the instrument, you get about minus 2, so the ratio is about 4. And so we can then have a discussion about these quantities that leads to big effects and huge potential health benefits from increasing annuitization. So you did that in your presentation with smoking, but I'd be more interested if we stick to that story to sort of rationalize or find out like what could be going on in terms of behavioral change such that we get that, and potentially also documented from the data. You mostly look at health outcomes, but I'd like potentially to see even prevention behaviors, or whether people quit smoking from the Chilean data, whether you can actually show us that this is possible. So I have three comments on the analysis. The first one is very methodological. I'm going to go quickly over it. You did go very quickly in the presentation over this, but you focus on people who have already died in a given cohort. I think normally we want to be very careful about that. There's going to be right censoring if you do that. So potentially move to something like this, hazard type specification, linear probability, but just say what is the probability that you die within 2, 5, 10 years or something like that, and just do the exact thing like that. That could potentially release some of the linearity, strong linearity effect that you're imposing on the number of years lived. Okay, I'm going to skip over that. Now, my main substantive point is this one. When you think of buying an annuities, of course, you get traction from the IV from this return on the outside option, which is affecting the relative price of annuities relative to the outside option. And so if you take the ENIA of kind of the standard framework for studying selection, you kind of have a price or cost on this here, and you have a fraction of people who buy the insurance here. The demand curve is sloping downward like that, that's demand. And under adverse selection, you get that the average cost of covering these individuals who purchase the insurance is going down, right? At high prices, it's only the healthy guys that are purchasing the insurance. And at low prices, as you lower the price, you eventually get the unhealthy individuals to come in. Of course, here it's when you live long that you're a high cost to the insurer, and the opposite is also true. So you get that fraction insured here. Now, what's happening in that variation of the outside option? Basically, the demand shifts down, right? The return on the outside option increases, so your willingness to pay to purchase an annuity goes down. So the demand curve, moves down here like this, D1, and so you get a reduction in the fraction of people who purchase the insurance like that. But what has happened in that standard selection model, it's actually the healthy guys that are staying on purchasing the insurance at that higher price, and basically the unhealthy guys have left. So despite the instrument sort of being exogenous, what's happening is you get the selection where you're only keeping the more healthy guys. And so that's perfectly consistent with the results you get purely from a selection standpoint, where in the end you end up having individuals who purchase, keep on purchasing an annuity even when the outside option is more interesting, living longer, okay? So a moral hazard story is one where the AC curve is shifting, right? In this case, it would be shifting down. If people start making more preventive behavior, then basically as a function of coverage, basically that curve is going down. So I'd be very careful in interpreting this as moral hazard because you can perfectly tell also a selection story. Now, what does that leave you? Well, basically what you can do is you can try and construct, you have in principle a lot of the data to look at the relative price measure of the annuity. And so you could potentially do that. There's very little in the paper on what's happening to the yield on annuities when the outside the stock market return is changing on funds. If I was an insurer in that market and I know that when the return on the outside option is going up, I'm going to get only the healthy guys staying and the unhealthy guys staying, I'm going to jack my price up for the, jack the price down for the annuity to make sure that I keep my pool representative. And here it would be interesting to see actually what's happening in terms of the pricing on these annuities as a response, okay? So I'd be careful about this in terms of interpretation. Now, the second point, which is very specific to Chile, and we were lucky last year to have as a job market candidate Edward Boone, who's here in the room, who presented us a very nice paper on the annuity market in Chile. And basically, Edward's main point when studying that market is that intermediators, advisors are playing a huge role in that decision. Basically, anyone who's dealing with an intermediator, or almost everyone, is going to purchase an annuity. And it's really the non-intermediated consumers where you find adverse selection, where actually the unhealthy guys are not purchasing the annuity and the healthy guys are purchasing the annuity. And so I think what's happening in terms of the late interpretation, so we already discussed, the selection on the numerator, but I think on the denominator there's also something happening here, which is that in some sense you're looking at the change, taking everyone, the change in the number of people who are going to annuitize, but really it's only a smaller fraction of people who will potentially change, because all those potentially who are intermediated or advised are not going to change. And so in principle, potentially, you're getting a very low denominator when in fact, if you had excluded those that are using intermediators or you use them as some form of control, I would expect that potentially the denominator would be a little bit larger, and so the whole IV estimate might be actually a little bit lower. So my advice would be to sort of try to think of using, if you observe that in your data, I presume you do, although I'm not familiar with these data, but potentially try and look, maybe within the sample. First of all, to do the first check of checking whether the return changes, whether there's a change in the number of people using intermediators. That would not be good, but suppose that's relatively constant, then you could actually use that contrast to try and get at that. So where does that leave us? There's two options. In my view, for the paper, you can continue down that route of that moral hazard effect. But also another interesting avenue is to really study this business cycle pricing and selection story, which I think is very, very interesting. You have very rich data. I'm not sure people have really looked at that. How should insurers react in a world like that, where basically the relative price of annuities is changing, and in principle, given that you have the data, that could be another alternative interesting avenue for the research. Thank you for the opportunity to discuss.
Thank you. So with respect to like the selection of like basically like it's a very I take it as very similar to Steve's point, this notion of like the switchers are basically healthier people. There's something that we haven't looked, we can look into with some a little bit of structure. One thing that I did look though is that I think that the story is slightly more complicated than this, because remember, you're thinking about the relative price of the annuity with respect to the program withdrawal. And the program withdrawal has embedded in it the annuity yield as well. So like the way that the program withdrawal payment is set up is such that you have the like actually life expectancy in the numerator and on top, and then some mix of the annuity yield and the stock returns on the bottom. So the relative price is the gap. And like what I have checked is that the gap between the first program withdrawal and the annuity that you get is pretty stable over time. So like kind of like in terms of like the choice that you're making, it doesn't seem to be correlated with the valuation that we look at. So a lot of food for thought, and I have to think about it, but kind of like that's basically what we stand there. With respect to the advisors, great point. Yeah, we're aware of like, although it was very hard to find out that he was Chilean, because he has like a German kind of name and like studying German, so complicated. I was actually puzzled why there's like this German guy studying like the Chilean auction system. But like, so the financial advisors, what I can tell you is that when you control for financial advisors, like the results do not go away. The reason that we haven't included it yet is because we talked to like the kind of some of the insurance companies, and the degree of advisor that they do varies, and it's very. There are some advisors that they literally just like walk you through the system of like kind of getting the annuity. There are some of them that they're very aggressive and like reach out to usually people that have like a big pile to deal with, because like the incentives are set on fees. If you were to look, you're right though, that if you were to look at like annuitizations, on average 70% of them claim to have an advisor. Program withdrawals only 20%, but like kind of like the actual action that advisors do our understanding, talking to the industry, is more of like a marketing device rather than actually in the way that we think about financial advisors in the US, where they basically like literally like providing some potential advice. So
they market just in the US too, as much as
yeah. That's what I said we think of. Well, so questions?
So in Australia, the largest annuity provider's main commercial advertisement is this lady who looks very sad in the stock markets, and she says, "Oh, I thought I would spend my retirement playing with my kids, but here I am watching the stock markets." And so they advertise saying she has this safe option.
Right.
And so I wonder whether when there is, say, stock market returns and very risk-averse people go like, "Oh no, I don't want to deal with that during my retirement," and they select into the annuity. It's not about the prices, but it's more the perceived stress thing. And then these more risk-averse people, they're also more careful about their lifestyle, their nutrition, their diet, and so I wonder whether the mechanism is through the selection of I guess more risk-averse people into the annuity during
Yeah.
life.
So there, I see where you're going. We have thought about that. In a way, kind of, again, like for that story to be true, it will need a bit more of a structure. You will need to argue that like risk-averse individuals, so especially when we focus on individuals at a standard retirement age, you will have to argue that the arrival rate of risk-averse individuals and retirement is different when like low market returns, when markets are low or high. We would love to have some sort of like cross-sectional sorting on like basically something that works for risk aversion.
At any given point in time, there's more risk-averse and less risk-averse people, and in in the.
But then if you are basically like looking at the sample that is forced to retire at a particular age, what would be a disproportionate amount of those risk averse precisely in low market returns?
Maybe they respond more to it. Like
But
they,
you have to retire at that particular time.
but if the returns are good, the risk averse will say, okay, I'm fine, I can use the drawdown. But if they will respond more strongly to risk, like returns going down.
So one thing that we thought about, but it doesn't quite solve it, is like there's evidence in that of like proxies for who are the people that respond more to like this extrapolative belief. So we can basically potentially sort on that, but that's also going to be time series variation and not perception. But if you have any suggestions on like how to think about like how to characterize risk averse individuals, like we'll be happy to.
But on that, I mean, with the exception of Antoine Bommier, the entire annuity literature, it seems to me, doesn't understand the distinction between atemporal risk aversion and intertemporal risk aversion. We're babbling on about cross-sectional risk attitudes, and this is variability over time. If you have a non-additive intertemporal utility function, they ain't the same. They bear no relationship. Yes, the two words R and A are there, but they're different beasties. So let me just urge you to look at that as a mere theoretical matter. The second thing I want to raise is your results about the interaction of a pure income annuity and health effects raises the elephant in the room, which has been advocated in many, many situations for social policy, most recently in the Royal Commission for Aged Care in Australia, healthcare annuities. If somebody was to offer a healthcare annuity, by all means offer a pure income annuity if you want to. I'll guarantee, I'm just asserting that based on common sense, it's going to dominate in terms of welfare effects and as a social policy. And at least at the very end of the paper, maybe talk about that, because if you're going to stress these surprising connections with health, they ain't surprising to people who know the risks. Societies have these income pension plans politically separated from the policies that deal with Medicare or health or aged care and so forth. You simply combine them in the same product. You've addressed the core welfare concern that's motivating this entire paper. So I'd at least see some discussion of that.
Perfect. Thank you. Appreciate that.
I think even, obviously, I have a personal stake, we believe that this is something, right? So take my opinion aside, but even then, I think given that they're so important for what people end up doing, I think as Kirk was saying, like the effect relative to that will be important somehow, right? The other thing is that the prices, I think the graph, maybe we can talk more later, but the graph that you're showing on like the return sources, I think, so in particular 2010 is very salient in my head, because I've been looking at the prices. 2010 is a period where the difference between the basic and the annuity was high, and the share of annuities in that year in particular drops very far. And the regulator keeps playing around year by year, or like not year by year, but they have been playing around with how they price the basic drop relative to the annuities. It used to be, as you say, the average of the annuities plus something. Now it's just a yield curve plus like some extra return on the stock market or other things. So, and the annuity companies will be responding actively also to that price. Right? So I think there's a lot of like minutiae there that
So
define things.
that's and again, it's like it's very related to Phil's point that it's well taken. Yeah, I mean like at least for the data that we have for the subsample of individuals that die, again another good point there. It doesn't seem that gap kind of fluctuates in the way that you're describing. It may be for like kind of earlier retirees, but again, it's like something that we could look into and like dig into.
So understand from the data, you have data from 2004 to 2022.
Right.
So you see people for at most 18 years after they retire.
Right.
And so I was wondering what kind of assumption are you making on mortality post 83? Are you assuming that these gaps?
Yeah, so like,
this
so I think that this is like, and we have been thinking about this. So like again, I wasn't bluffing when I said this is an early project. Okay? So these are basically like kind of like we thought about like kind of like what is like a simple specification that you can run. We run that. But that's, I mean, you're hinting in the same point that Felipe was hinting, that in a way, if you think about the CDF of people dying, in a way, from different cohorts, you're getting a truncated distribution there. And we were thinking precisely in the lines of what you described it, and like basically, if you change kind of the outcome variable to be some sort of like the fraction of individuals that die at a particular age, for kind of like a cutoff that look at all that has a common intercept with all the CDF in our cohorts, then like this like notion of truncated effect will be kind of diminished. So like, but it relies on a different specification. We haven't done it. We're basically like, we have just thought about what we can do. But that will be kind of the solution to that. But you're right. Like basically, like if you look at like the earliest cohort, you're gonna see a CDF that kind of go up to here. So if you were to kind of think about it, like an early cohort CDF, we're gonna look like this. You see it here, kind of like a later cohort. You're gonna go like this. You're gonna see it here. So if there's something funny happening at this end of the CDF distribution, maybe that's what is driving our results. If we basically think about this as like the minimum point that we look at, if we look at the fraction of people that have died here in the lines of what Felipe said, we can try to like basically kind of alleviate those concerns. So that's like kind of in the lines of what we're thinking.
It's also related to moral hazard, because I think if you didn't see anything at the beginning, like within 2 years, but you started seeing things going forward, that I would still be more sympathetic to moral hazard. But if you saw like Edward
right away,
that it's right away, then I don't really think that can be moral hazard.
Exactly, and that's what we were actually pretty happy with, like the health status results. Again, cross section, not a panel with all the caveats, but I mean, at the very end, like what we're trying to think about, like almost like an outsider in the literature here, is that kind of like the notion that kind of like annuities cannot have a treatment effect on longevity seems a bit like a push, and we didn't want to push it on like the presentation, but in a way, like many of the earliest papers almost assume moral hazard away. And I was basically trying to like bring back that debate to the table. Thanks a lot for the comment. I appreciate it. I'm looking forward to it.